Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenevec from Bloomberg Radio.
We started, though, talking about the mega cap tech names, and one in particular, Tim, is on our radar. Apple shares still down about 2.9% today.
Yeah, this follows independent research from Counterpoint Research, noting that Apple's iPhone sales in China fell by a surprising 24% over the first 6 weeks of the year, with the iPhone slipping to fourth place in China in the first weeks of 2024. New Street Research's head of technology infrastructure, Pierre Ferragu, weighing in on China's struggles earlier on Bloomberg Surveillance.
If you look at Apple, really, it's a competition. It's mostly a competition issue. So Huawei is back in China. They were not able to do phones for quite a while because they couldn't access chips manufactured at TSMC anymore. Now they figured out a way to do chips domestically on mainland China. They are back, and Chinese consumers like to buy Huawei phones.
That was New Street Research's head of technology infrastructure, Pierre Ferragu, earlier on Bloomberg Surveillance.
All right, we said Apple down about 3% today, down 7 out of the past 8 sessions for a loss of about 8% in that time frame. Let's get to it. More on the Apple stock and the company gloom or apparent doom. With us is Bloomberg Intelligence Senior Technology Analyst Anurag Rana, joining us from our Chicago bureau. Anurag, let's talk about Apple. Concerns about iPhone sales in China falling by a surprising 24% over the first 6 weeks of this year. This is according to one report. Put it in perspective for us. Should we be concerned?
Oh, yeah. This has been the big concern for almost over, now probably close to 12 months. And it doesn't look like there's any, news of relief at this point. China consumer weakness and, the Huawei phone, which got its first upgrade after many years. Those are the two factors that are, having people not choose Apple at this point. And again, this is the biggest growth driver for Apple in the near term is China and other emerging markets. And if China, catches a cold, then it's going to be a problem for Apple for at least this year and perhaps even next year.
Well, Greater China accounting for 19% of Apple's revenue in fiscal year 2023, Anurag. How does Apple turn itself around here? How does it improve this cold, that, as you call it?
I think it's going to take some time unless they come up with some new AI features by summer that can help drive this, I would say weak iPhone sales refresh cycle. What has happened over the last 3-4 years is the iPhone, being such a sturdy product, has seen its life elongate, which means before the refresh cycle was about 3.6 years. If it gets extended by 4 years, then you're going to sell less new phones every year compared to the last few years. And that's what's really happening. And the second thing is each of these phones are getting more and more expensive. So people are keeping them at a longer period of time. In order to refresh that or in order to change that, you need to come up with new features. And that's not been the case, although I would say that the 15 does have a much better camera than anything else out there. But I think AI could be something that can jumpstart that. But we are so far away from them even showcasing what they can do, let alone hoping that that's going to drive more iPhone sales.
So is an AI generative or generative AI, I should say, iPhone, is that the answer? And what is this? I know Samsung's already got something out and seems to be getting a lot of attention, but is that it?
It's basically that your operating system itself, the default system on the phone, has a lot of those features for which you're using applications right now. And if Apple's able to pull some of those things out, people with older hardware, less memory, the battery running out, not a faster processor, will basically say, well, if I want some of these features, I'm going to go out and upgrade my phone. So that's really what the driving factor is. But those features need to be, pretty damn good in order for somebody to go out and buy a new phone.
I mean, what kind of features are we talking about here? Because it seems to be a simple fix would be, offering consumers something that they do repeatedly on their phones, like getting off the subway and realizing, okay, I need a city bike somewhere. This is a New York example. But why doesn't Apple just have the technology to tell me, okay, the closest electric city bike is at this station, which is this far away? Like, I do this every day on my commute home.
Their data set's got to be incredible.
It's got to be
on
incredible.
All of us.
It seems like an easy lift.
that is an easy lift in principle. But remember, Apple was, wants to do a lot of other things also. And that's why, we were happy that they got rid of that car project. We think it was not a smart idea. And now they're refocusing all their attention on Gen AI. That's good because at the end of the day, you can experiment all you want, but the phone is really your livelihood. And that's where the attention needs to be. Focus on that, make it develop better than faster than anything else. And, the user will follow.
This is all about the ecosystem, the Apple ecosystem. Everything's got to feed it, right, Anurag?
Yep, absolutely. And, imagine that, we say that, iPhone's only 52% of sales. But if I were to add the headphones and the watch and other things, the Apple ecosystem is far bigger than that. And not to forget all the services, because those are double-digit growth numbers. And that's where, a lot of the monetization can happen too. And it's a much higher margin business. So you got to go protect your ecosystem. Otherwise, you're going to be in this 2 to 5% growth for many years to come.
All right, good stuff. As always, Bloomberg Intelligence Senior Technology Analyst Anurag Rana with the latest on Apple. Shares down about 2.8%, off their lows, but still down a lot.
One thing I talk about all the time is the iOS ecosystem. It's not as strong in China because of the over-the-top apps, the payment apps, the all-in-one apps that people use to communicate. It's not like iMessage here.
It's not like something we have embraced, but it's definitely something you see in China in a big way.
As much as Facebook has wanted us to embrace it.
Exactly.
For us to embrace
Apple
it.
shares, by the way, they have been down. They're down almost 8% since about February 22nd.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We do want to talk about the real estate space, and there is one story that caught our attention about how the $1 trillion asset manager Blackstone plans to more than double its holdings of Indian warehouses and may eventually take the logistics business public as the asset manager increases its bets on the world's fastest growing major economy. So big bet on logistics, big bet on India.
Blackstone, of course, a big player generally when it comes to real estate, everything from data center, office, residential, and more all around the world. More generally, from a U.S. investment perspective, the Bloomberg US 300 REIT Price Return Index, it's down, Carol, roughly 1% year to date, fractionally higher, though, from about a year ago.
Yeah, so kind of little changed on the year. So let's get to our interview this hour. Here to talk about REITs is John Worth. He's Executive Vice President of Research and Investor Outreach at Nareit. It's the National Association of REITs, which is a global voice for REIT and real estate companies. They've got a focus and, of course, interest in U.S. real estate. That makes sense. John, based in Washington, D.C., joining us here in studio. John, great to have you here. How are you?
I'm great. We're doing quite well.
Well, tell us about how well, because when we talk about real estate, right, it's not just location. It's also what kind of vertical. There's all different types.
Data center. I think you could say, right?
Is it all data center? So tell us about the different sectors, where there's growth, where there's weakness.
Yeah, I think that's a great question because I think one of the things that so many people don't understand is the breadth of real estate today. So and really, we like to say real estate houses the economy. So it needs to be as broad and diverse as the economy. And REITs have really been on the leading edge of innovation in this space. So they're some of the leading owners of data centers, which you mentioned, which is has been the best performing property sector last year on a year-to-date basis this year, and really being propelled forward by AI tailwinds that don't look like they've got really any end in sight. There's a lot of momentum in that sector, but we've also got self-storage facilities, cell phone towers, healthcare facilities, as well as the more traditional sectors of industrial and logistics facilities.
This is where growth is?
We're seeing a lot of growth in industrial and logistics over the long term. We think even though this year the demand has been a little slower. In the multifamily space, we're going to see we see those long-term tailwinds. Of course, in the cell phone tower space, lots of tailwinds, and then more broadly, the whole sector has really been doing quite well since we've sort of entered this period of a monetary policy pause. On a year-to-date basis, we're about flat, but if you actually go back to the end of October, REITs are up about 20% since then.
Okay, more on rates in just a minute,
yeah.
But what about where you're seeing weakness when it comes to all these different sectors of REITs that you talked about? We know data centers are certainly doing well with
Absolutely.
the AI frenzy. What's not doing so well?
Well, I think if we look back over the last couple of years, by far the worst performing sector has been the office sector, which I think has really been weighed down by what are the really meaningful work from home risks. I do think what we're going to see in that space, and we're clearly in the middle of what is a kind of multi-year experiment in how we live and how we work. And what we're seeing there is
Are we still experimenting, or have we figured it out?
I think we're still experimenting.
Okay.
I think that we are seeing more organizations ask their employees to come back to work. I think that as we're seeing academics look into what the productivity impacts are, what we're realizing is some of what we saw early in this experiment in 2020, 2021 was a little bit of a sugar high, and that it's not all positive when it comes to productivity. That said, workers, especially white-collar workers, they really like their work from home days.
Nobody's commuting on Fridays. We see it.
Except for us.
Except for us.
You cannot get a pickleball court in the suburbs on a Friday. That is absolutely true. But I think it's still an evolution. And part of what we're seeing, and you certainly see this in New York, is it's a flight to quality. So if you own the high quality office space, which I think by and large that's where REITs have focused, in terms of demand, you're going to be in a pretty good place.
Okay, so let's talk a little bit about the rate situation, because we're at a point where, Carol, I think we've almost gone an entire show without talking about the Fed.
Don't do it.
I'm not going to.
I know Jay Powell's speaking tomorrow.
He's speaking tomorrow, so I want to give him some time to breathe and get ready.
We can do it. It's relevant.
Okay. When we're in an environment like this, where the entire market is on its toes about when is the Fed going to cut rates, what typically happens with REITs?
Historically what we've seen, and this cycle is following a very similar pattern, that we see REITs underperform during the period when we're in that monetary adjustment phase. And then they're going to outperform once that rate rising cycle is over. So what we saw late last year was we saw a nice little bull run in REITs in the last couple months of the year.
Right.
That maybe was even when I think markets were a little over enthusiastic about how
exuberant over how many times the Fed was going to cut rates.
Not a Jay Powell term, but yeah, maybe so. About
maybe he'll say it tomorrow. I don't know.
But I do wonder then how much, as you say, REITs are up 21% from that late October low last year. How much of the exuberance over how aggressive the Fed would be about rate cuts is already priced in?
Well, I think we've seen the pullback this year in terms of that forward look. And when we
pullback or leveling off?
It was a little pullback, and that now we're about level after REITs were up a bit in February. And I think when we get the signal, when we really see rates start to be cut, I think there's more bullishness sentiment in REITs, because one of the things that when we get past the macro elements, people and investors can start to look through it to the actual operating performance, which has been quite good, and the balance sheets, which are quite strong, and REITs are really well prepared.
Not every sector? Are you speaking every sector?
Really across the REIT sector. Now, this isn't commercial real estate generally. This is the publicly traded REITs, where they've really showed a lot of discipline in their balance sheets. They've got a 6.5-year weighted average term to maturity. About 90% of their debt is fixed rate. So they've really prepared themselves to work through this period.
Hey, I just want to end with going back to data centers, because they really are so hot right now. Are your members at all concerned about regulatory concerns when it comes to data center power usage, and essentially communities saying, no, we do not want this here because it uses so much power and doesn't provide a ton of jobs, frankly?
Yeah, I think there's a real concern that the ability to add new supply in the data center space is really going to be constrained over the next couple of years. The siting has become more difficult in terms of power, in terms of water usage. That said, if you look at some of the data center REITs, they have tried to be very forward-leaning in terms of sustainability, in terms of generating power through renewables, limiting their water usage. But that's gonna be a real issue. Now, that said, as an investor, that supply constraint can be a positive, and that's part of what I think is propelling the REIT stocks in that space, because they've been in this space. They have a well-established position in lots of facilities.
Well, great to check in with you, and thanks for stopping by while you're in New York. John Worth, he's Executive VP of Research and Investor Outreach at Nareit.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Businessweek with Carol Massar and Tim Stenivek on Bloomberg Radio.
It's Bloomberg Businessweek. Carol Massar, Tim Stenivek. Carol, I got to tell you, this story blew my mind, okay? Because we think a lot about immigration, but not necessarily in the context, at least politicians don't think about it in the context at all, or they don't present it in the context that I think many would argue should be presented in, which has to do with employment and has to do with how much we're going to lose if we don't figure out the worker shortage.
Well, they should just listen to us because we talk about it.
In the U.S. We talk about it. Okay, so the U.S. has never relied more on immigrants for economic growth. By the end of the decade, the severe labor shortage could lead to $1.75 trillion in unrealized economic output. That is real money in a very short period of time.
Well, it's real, impact on the economy. So you think Congress would be doing everything and anything it could to make it easier for immigrants to address the severe labor shortage and fill jobs that Americans do not want to do, something that we have been talking about, to be quite honest, for years.
So is that happening?
No.
Okay, it's not happening. Well, Enda, Curran, and Augusta Saraiva write all about this today in one of the most read stories on the Bloomberg terminal. Enda Curran is Bloomberg News global economy reporter. He joins us from Washington, D.C. Enda, the numbers in here are just staggering. So to what extent right now does the U.S. rely on immigrant labor?
It relies on immigrant labor a lot at the moment. So, to be clear from the outset, this is very political and very divisive, like you were saying. But we came at this angle through the economic and business lens, and we went out to speak to business groups and trade groups, many of whom are based here in Washington. And we said, look, what's your take on the immigration debate? And they all had the very same message. There is a chronic shortage of workers. They need more legal migrants to be allowed in, but they're getting nowhere with Congress. And this is from across the spectrum of groups that represent every corner of the economy. And in fact, they're stepping up their measures in terms of how they're hired. But as you mentioned, the numbers are real in terms of the worker shortages. The numbers are real in terms of the economic damage and the potential, of course, if more legal immigrants do come into work, is that the numbers are real in terms of generating additional revenue for the economy too.
So in other words, Enda, if you run a business, let's say Chipotle, for example, or another fast casual QSR, or perhaps you're in the construction industry, or perhaps you're in any sort of other business, this is not political. What you heard from all of these folks and the trade groups that represent them is one single message.
Correct. They were crossing party lines. They were naturally careful to make the point they advocate for legal migration. But they were laying it on down the line that both sides of the aisle are not addressing this issue for them. And we spoke to representatives and business people all the way around the country, farmers, nursing home representatives, you name it. And they all explained that they have vacancies that they couldn't fill locally and that they've had to, recruit from immigrants coming in. Now, of course, immigration isn't the only solution. They do say you need to invest in skilling up the local workforce. Education plays a role in all of that. But the end result is that there just aren't enough workers to fill all the vacancies around the country right now. And that's why these companies are saying it's at a crisis point. It's not a new problem, but it's gotten much worse than it ever was.
Yeah, I have a friend who's a lawyer who works down in D.C., and it's all about getting workers from outside the United States, foreign workers, basically work visas, and so that they can work in this country, often for a long period of time. Having said that, your story makes a distinction between legal and illegal immigrants. That's an important distinction. Talk to us about that. And then what is holding up the legal immigrants who are here from getting work visas?
Yeah, so it is important. These companies and trade groups that we spoke to, they're talking about legal migration, number one, and doing it correctly and properly. And of course, they're not advocating for the problems that have been seen on the southern border this year. But at the same time, though, they are making it clear that even if there cannot be a grand bargain, we'll say, in immigration, and we saw that kind of deal fail a few weeks ago, there needs to be at least some piecemeal bits and bobs in here and there that will free up or lift the cap for skilled workers in certain sectors, certain areas, to at least take the pressure valve off, to allow workers in where they can. And that's what they're hoping for now. Of course, it's election year, so it makes it all the harder. But they're drumming up their message. So as I say, we spoke to, it is an equipment manufacturer group who is flying people into DC to try and get the point across to lawmakers that they don't have anyone to drive their equipment. There is a group that represents franchisees. They're getting new members flooding in, like Yum and Chipotle, you mentioned. And they're in their meetings with lawmakers who are saying, hey, when you're in a restaurant and you can't get served, you want to know why? It's because there's no labor. They're putting this across in colourful terms. As a construction group we spoke to, for the first time launching a digital advertising campaign in the election on immigration. They haven't done this before on immigration. They're going to target certain seats around the country. So the interesting thing was, when we spoke to these people, Augusta, my colleague, and I, that this is not new. You all know the story backwards, but they're saying it's at a point now where it really hasn't been before, and there's no sense of a legislative breakthrough. I mean, I had people give me a lecture on what was done in 1986 under Ronald Reagan, for example. That's how far back people are saying the reforms need to be updated to. So a lot of work to be done, and businesses are crying out for it to be done.
But Enda, what's holding it up? Is it somebody saying, stamping it, approved? Or like, what is it? Is it judges? Is it like, what is it that's actually stopping the process? Or is it caps in terms of the number of workers who are actually allowed to get these work visas?
Yeah, it seems to be a couple of things. So first of all, people will say the current systems are outdated, antiquated, expensive, bureaucratic. I spoke last week to a farmer in Arizona, for example, and for the first time, he went on the H1 program to get some 4 workers in, and he just explained it cost a lot of money and took a lot more time than it should have done. So there are complaints about the existing architecture that's outdated, they say. But then, of course, you go into the current influx, and the system cannot cope with who should be a legal migrant and not. That's playing out at the moment. And then you go into the politics of it, and we saw that play out a few weeks ago. For different reasons, different parts of the political process don't want to agree on a deal at the moment. And the end result is that it's in a bit of a funk, and employers don't think it's going anywhere soon, and they're screaming out, hoping that something will be done at some point.
Hey, let's take a step back and talk a little bit about why the U.S. faces this crisis right now. I mean, there are some fundamental things happening. One is that baby boomers are retiring, so they're no longer going to be in the workforce in the coming years. And then the other part of this has to do with birth rate. Millennials are not having the same number of kids that previous generations did. So if this doesn't get solved, what do we end up looking like here in the U.S.? Do we see an economy that looks like Japan? That's exactly what I was going to say. Do we look to Japan for what happens?
And China as well. I mean, the demographic story is a challenge in many major economies around the world. It is the same for the U.S. The U.S. is not as chronic as other places, but it absolutely is. So there was a Congressional Budget Office paper out recently that we cited in the article, making the point that in broad terms, population growth, over the coming decade or so is probably going to rely on immigration. That's how critical it will be to growing the labor force in this country, because as you mentioned, the boomers are retiring, the birth rate isn't keeping up, so something has to fill that gap. Now, I should say, by the way, of course, there is spirited academic debate in terms of what immigration or how immigration impacts wages, especially for lower income workers. It's important to flag this. There is literature out there that suggests lower income wages will grow more slowly under a scenario of immigration. So there are downsides in certain sectors, and we mentioned that in the article. But the net takeaway, including from the CBO, is that without immigration, the population won't grow. It would add about 7 trillion to the economy and create about 1 trillion in revenues for the government. So there are negatives, but there are more positives as well.
So there's the immigration debate to have up on the political campaign trail, I'm thinking.
Oh, is that going to happen starting tomorrow after Super Tuesday?
Well, it's a much more productive conversation.
Productive? Did you say productive? And did you say Capitol Hill in the same sentence?
I know. I'm living in this
critics might say.
Wait, you wear glasses, but let me take off my rose-colored glasses.
I would say there are critics out there who say that there's not a lot happening on Capitol Hill.
Unbelievable. Enda, a killer story. I mean, Tim and I just can't get enough of it. It's such an important story. It's a must read. We're going to put it out on our social feed. Enda Curran is Bloomberg News global economy reporter joining us from Washington, D.C. This has got to be part of the narrative. Critics would say.
Is it going to be?
Non-critics would say.
I think everybody says this has got to be part of the narrative.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 17 and a half minutes left to go in the trading session on this Tuesday. Charlie, of course, just breaking down the numbers. We're pretty much hovering at our worst levels of this session. The NASDAQ taking the biggest beating, down about 2% here on the day. Let's get to it. Let's get to our Drive to the Close guest, Tim.
Yeah, we got Nancy Prial back with us, co-CEO and senior portfolio manager at Essex Investment Management. Got about $700 million in assets under management. Nancy joining us from Chicago. Nancy, good to have you with us this afternoon.
Thank you.
A day like today, the worst day for the NASDAQ 100 going back to October. We're seeing some significant selling on the S&P 500. Look, for context, the S&P 500 is still up 6% year to date, but are you concerned on a day like today?
No, we're not. I mean, we've actually been expecting to see some kind of a pullback. We've had extraordinary number of days of the market going up, of tech going up, really without a pause. And we were actually getting a little concerned that there was a level of complacency coming into the market. As we know, nothing goes up in a straight line. And so this, we think, is a pause that refreshes. We also think that, interestingly, we're seeing some breadth in the market underneath the weakness that we're seeing in the large cap indices, particularly in the NASDAQ and the QQQs, as investors are starting to think there might be other ways to play some of these phenomenal growth trends that the market has been positively reacting to. And we think that's very good news, with the Russell down a little over 1%, so outperforming most of the large cap benchmarks.
Is there any significance that when we talk about the NASDAQ 100 down the most since October 25th of 2023, that on October 26, 2023, we hit a low and then was just a march to the upside? Like, I always technicals, whatever, or how investors look at things. Is there anything significant in that, or is it just a coincidence?
At this point, I would say it's just a coincidence. I don't think that this is going to be a one-day V-shape back. My guess is that we're going to see a period of churning here. I don't think we're going to go down a lot, but I don't think we're going to go back off to the races either. I mean, as you mentioned, since October 26th, it's been pretty much a straight line up. There was a lot of pessimism in the market at that point, a lot of concerns about inflation, interest rates, et cetera. We've had a little bit of the opposite of, everybody now expects a soft landing. Everybody's looking for the first Fed cut. Everybody's debating how many Fed cuts there will be. We're going to need to digest that and come back to some point in the middle. And we think in that environment, again, that the key will be stock selection.
Digest or get some clarification. Thank you, Jay Powell, who's going to be up on Capitol Hill tomorrow.
Well, both. And we don't expect Mr. Powell to say anything that will be particularly clarifying. We think he will hedge his bets as they remain data driven. So we are optimistic that it really is more a period of digestion than clarification. Just we don't expect the first Fed cut before June. And we think the market is going to come to that. And at that point, when the Fed does cut, hopefully it will be a positive surprise to the market as opposed to something that's already been discounted in the market. So we think we can go sideways here for a while. And again, companies who can outgrow expectations will be with attractive valuations will be in a position to thrive even in that environment.
Are you buying today? Do you see today as a buying opportunity?
We are selectively buying, not necessarily the things that are getting hit the most today, though. Again, we are looking at companies that have not yet been fully discovered, fully recognized by Wall Street, where those opportunities are just starting to emerge, maybe where there's been a recent earnings report that was better than expected. And so those are the names we would be buying in this kind of an environment, as well as the names we were buying yesterday as well.
Well, it's funny because, we focus on, obviously the overall indices and what they're doing. And we're just, we've come off, we're bouncing a little bit off at the bottom here. But having said that, a name like Target is up 11% today, your number one performer in the S&P 500. This has to do with its earnings results. I mean, companies are discretionary companies, I should say, investors are, they kind of weed through and look at the fundamental story, right? And they are willing to buy even on a downward day. That says something.
That does say something. And that actually is a little bit of a change in the market from where we had been, where it was much higher correlation. Everything was moving together. It was risk on or risk off, interest rates up, interest rates down. What we're starting to see again is some of that broadening where investors are looking for those individual stories, those individual stocks, or even maybe some individual themes that can report better than expected where it's not yet fully discounted in the price of the stock. Seen that with Target. We've seen that with a number of other companies in this reporting season as well.
Okay, so you mentioned soft landing. You came on with us back in August, I believe, and you said that there was likely going to be a soft landing. I imagine you have even more conviction now?
Actually, I guess I'm a little bit contrarian in this. I'm a little concerned that there is complacency building in the system. We don't think we're going to have a deep recession, but we do think that there are some signs of some slowdown, particularly in capital spending, and we're not quite sure where things are in inventories. So we still think a soft landing is the best case scenario and the likeliest scenario, but it might be a little bit bumpier than what the street is currently anticipating, meaning we could have one quarter again that shows a little bit of negative growth. What we think, we've seen some kind of rolling recessions out there in the marketplace for the last year or so, and that may continue to happen where different sectors underperform at different times. It seems that, with the Target report, maybe the consumer is coming back a little, but capital spending is certainly slowing down a little bit as well.
Hey, just got about 30 seconds. Give us one name that you like right now that you might be buying. I know you shared a few with our producer.
Yeah. So a company that reported fairly recently that we still really like is a company called Docebo. It is a bit of a play on AI. It's also a play on employment being strong and the need to do corporate training, workforce retraining. It's a Canadian software company with a learning management system that uses AI to customize learning for new employees, particularly focused on sales and marketing, and allows you to deliver that training in a way that's very customized to the individual and much more cost effectively for the company. They reported a great quarter, better than expected.
Great.
Stock reacted nicely, and we think it still has room to go.
A real quick synopsis. We appreciate it. It's about a $1.6 billion market cap. Stock is up, by the way, up about 8%. Docebo, that ticker is DCBO. Nancy, thank you so much. Nancy Prial, Co-Chief Executive Officer and Senior Portfolio Manager at Essex Investment Management, joining us from Chicago.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.